In construction, the foundation layout depends on the building type. The foundation for an apartment building is different than a custom home than an office building. The same is true with QuickBooks Online. The foundation is your chart of accounts. And how you set up your financial accounts depends on your business structure. A sole proprietorship may have accounts that are different than a corporation or a partnership. In the file I'm setting up, it will be a corporation taxed as an S Corp. So let's get started. This is the QuickBooks file we will be building our foundation on. Now, QuickBooks gives you a generalized chart of accounts. So you want to go through it, you want to clean it up, and you want to set up the accounts for your business. QuickBooks focuses on 5 general categories: the asset accounts, the liabilities, the equity, and income and expenses. If you're an S Corp, and I know this because I've been a tax prep for 10 years, for an S Corp, when you're looking at your equity accounts, so let's look at the balance sheet accounts and let's look at your equity accounts. Let's see. One of the things that you will see, or you would need to have, and you may not see it because, like I said, QuickBooks gives you general accounts. It might not even be set up for an S Corp. It might be set up for a partnership or a corporation or sole proprietorship. But as an S Corp, you want to have capital stock. Capital stock is your original investment into your business. You also want to have additional paid-in capital. And this is actually on the 1120S. Additional paid-in capital are additional investments or funds that you have put into your business. Another one that is used is the shareholder account, shareholder distribution. This says partner because QuickBooks has set this company up as a partnership, but it's okay. Shareholder distribution is another account that S Corps use. What is a shareholder distribution? Shareholder distributions are funds that you take from the profits of your business. Now, if you are mixing your business funds with your personal expenses, I don't recommend this. That's a big no. But if you are, any personal expenses goes into shareholder distribution. You're essentially using your profits already before, anything else. So it's not recommended to do that. But if you are, for whatever reason, you need to do this, or you do transfers from your business account to your personal account, use shareholder distribution. Now, if you do need to use business funds, and as small business owners do as they grow, I tell my clients, I rather see you transfer the money and have like a lump sum than see transactions from Target, Walmart, Amazon, all these, because it just creates more work and investigation for myself. But if you're doing your own books, you will know what each transaction is. But what we want to do is keep the chart of accounts simple. We want to only use QuickBooks for business transactions, because that's the only way that you're going to be able to get the right KPIs, the right numbers for your business. If you're mixing personal, then it's kind of hard to know exactly what your business is doing. So shareholder distribution is one of the main accounts that I see. To set up the accounts that you're going to use to record your job costs, you want to set them up as cost of goods. The cost of goods is on the profit and loss. So I believe I have already set up materials and supplies. Another account can be subcontractors, permits, equipment rental, anything that you use for jobs only. And then you have your revenues account, which is construction. I also have change orders as a service income, because what the change order account can tell you, if you see a large amount in here, is that you're probably not bidding your projects correctly, or there's something happening on site, on the job site, that you constantly need to adjust the contract price. So the change order is very helpful to see any changes needed to be done with estimating or project management. Another account that I want to talk about is retention. If you're a subcontractor, the GCs will deduct 5 to 10%. Some still do 10, between 5 and 10% from your contract price on your progress billing. So you need to keep track of that retention. To create a retention account, you want to go to New. Let's call this retention. The account type is other current assets. Detail type is retainage. Now, retention goes onto the balance sheet. It's not on your profit and loss. It is money that is owed to you, so it will be alongside of other assets on your business. So once you get all your accounts into QuickBooks, you start building this foundation that you'll be able to use the reports such as the profit and loss and the balance sheet to analyze your business. So knowing what accounts to use, whether you're a S Corp, C Corp, sole prop, is so important. I've seen companies that are sole props that try to use the accounts as a C Corp, or I've seen C Corps try to use the accounts as an S Corp. Setting up your accounts the right way is so important because it flows onto your tax return. So if you're an S Corp, you don't want to set up accounts like a sole proprietorship because that's a totally different form for your CPA or tax preparer. Once you set up this step, then you're on your way to a stronger financial foundation using QuickBooks. Thank you for watching. I will see you in the next one.